Every few years, the exact same pattern repeats. Markets rise, people build vast fortunes, and then the structure suddenly shatters. Billions of dollars are wiped out in a matter of hours, leaving panic in their wake. A market crash is a rapid, simultaneous destruction of value. It happens when stocks, real estate, or crypto drop all at once across the board. But the visible panic is misleading. A crash does not begin on the day prices drop. It begins the exact moment prices disconnect from reality. The chaos you see on the news is merely the delayed realization of a pre-existing illusion. Take a look at this model of a closed economic system. Imagine a small town with exactly 100 people and 100 housing units. At first, each house costs $100,000. Everything is perfectly stable. Supply meets demand. If new people move to the area, demand increases. Naturally, the baseline price ticks up to reflect that organic growth. But soon, people notice a pattern. Prices always seem to go up. So they stop asking what the house is actually worth. They only ask if it will go higher. Buyers start paying absurd premiums for the exact same physical structures, solely because they expect the next buyer to pay more. When collective expectation entirely replaces foundational value, you have a bubble. Logic disappears. The perceived safety of acting with the crowd overrides individual mathematical reason. People keep buying at absurd heights, because in this environment, participating early rewards you far more than being factually correct. Human psychology is what inflates the asset, but what turns irrational behavior into a systemic disaster is borrowed money. Instead of using their own money, buyers put down a $10 equity block and borrow $90. If the market increases 10%, that small gain doubles your original investment. But if it drops 10%, the equity is erased. Only massive debt remains. Debt completely dismantles the natural shock absorbers of an economy. It amplifies individual profits, but guarantees systemic destruction. Once a market is highly leveraged, it becomes hyper-fragile. It doesn't take a major catastrophe to break it. It just takes a tiny disruption. The trigger is almost always mundane. A slight increase in interest rates, a company missing its quarterly earnings, or a lukewarm economic report. That small crack forces a complete psychological reversal. The entire market stops calculating potential gains and starts agonizing over potential losses. Confident buyers instantly evaporate, leaving only anxious sellers. A market collapse begins the exact millisecond that the emotion of fear mathematically outweighs the emotion of greed. Panic creates a structural impossibility. An immediate oversupply of panic sellers is suddenly met by a total vacuum of buyers. Because no one is buying, sellers desperately undercut each other, forcing prices into a rapid freefall. Plummeting prices trigger margin calls, liquidating leveraged accounts. This accelerates the drop, collapsing connected debt blocks in a continuous loop. The destruction bleeds out of the stock market and into the real world. Terrified banks freeze their lending. Without credit, businesses halt operations and begin laying off workers. Because the modern world operates on intertwined debt, a localized financial crisis guarantees a broader economic recession. You might wonder why we can't prevent this. In theory, better regulations and increased market awareness should entirely stop the cycle. In practice, those safeguards consistently fail. Economic crashes are built into the system because their root cause is immutable human behavior. The same emotional duality governs every financial system: irrational greed inflating the bubble on the way up, and overwhelming fear accelerating the drop on the way down. This flat line shows us the final reality. Markets don't crash because mathematical models fail. They crash because humans naively believe the good times will never end. When that delusion breaks, the system resets.